Good evening, friends. This is Katavaz here. We're going to look at computerized accounting, just specifically depreciation. If you're given depreciation, how do you deal with it? Okay. For that matter, we'll start with assets. Maybe if they have opening accumulated depreciation, we should also include. And then we also look for depreciation for there, depending on the method we are using. Okay. So without waste of time, I'll share. Okay, before I share QuickBooks, let me first say something about the question. So this question is fairly rich, a lot of content, but stick to what I had or what you're going to discuss, which is the depreciation. Of course, by this time, I expect you to be knowing how to capture the company name and this other information that is given, the location and everything like that. Okay, the year end, when the year starts, you should be familiar with the information by now. So without waste of time, if you go to the balances, maybe to read what they're saying. They're saying that the company's accounting system has been purely manual, and management agreed to computerize it effective 1st January 2018. So we're starting business, okay, like officially to use the QuickBooks on 1st January 2018. So saying off-shelf QuickBooks accounting software was purchased and handled over to the accountant to start on the work immediately. In addition, the following balances have been extracted from the book of accounts as at 31st December 2017. So if we're starting our year on 1st January 2018, and you're given 31st December 2017 information, that is your trial balance. That starts there, or we can call them the opening balances. Because a few minutes to midnight, 31st December 2017, and a few minutes after, 31st December 2018, you go into 1st January 2018. So usually there's no difference between 31st December 2017 and 1st January 2018. Okay, so these are opening balances, and that's what you're going to use. Now, if you're given opening balances or a trial balance showing opening balances, you capture them the way they are. So our interest is mainly on the fixed assets and how we can depreciate them. So here you have other assets and liabilities. You're given trucks, you're given accumulated depreciation of the truck, you're given the building, and accumulated depreciation. So you can start with those. When you're given trial balance, you must open accounts for them, and then you capture that information. Okay, so you can go to QuickBooks and capture this. So I hope you know how to access the QuickBooks, because you go to desktop, you look for a blue icon that has QuickBooks, then you open it. These days it's green actually. The recent software is green. It has QB on it. So you still open that. Okay, by assuming we're sticking to this blue one, which we studied, you open the blue icon. You double click on it for it to open. Now, once it opens, this is what you will see. Okay, something like this. Let me just take you there. Okay, something like this will show up once you open something like this. So you, of course, you don't open the company name that is there. you're supposed to create a new one and then you start. But for purposes of time and sticking to what you're covering, I'm just going to open one of the accounts that I have. Okay, yours must not have passwords because the lecturer will not look for you to ask for your password. Okay, so it should be easy to access. So this is what you will see. Okay, something like this. So I encourage you to always clear the dashboard. Try to have it empty. Okay, something like this. And then you start. After depreciation, some coin to depreciation opening balances. Do we take that 1st December or 1st January 2018? For opening balances, you take the 1st January 2018, not at 1st December. Okay, as a matter of fact, the period we're referring to is 1st January 2018, 31st December 2018. So balances that belong to 2017, 31st December, I've told you that the difference between 31st December 2018 and 1st January 2018, there's I think like just 1 minute difference. In fact, even seconds that make the difference. So therefore, 31st December 2017 balances become 1st January 2018 balances. Okay, let me first answer some few things before you ask the question. Okay, so we capture the opening balance. Someone should mute it. It's Uganda is very fast microfinance. You have 4 guys and you're not muted. So for opening balances, we are aware that you go to accountant, okay, and make journals. Okay, for most of the opening balances, and the reason is because we normally use journals to capture opening balances.
Anything, we're not seeing the transactions you're doing.
I've not started working on it. I'm just saying that when you're capturing opening balances, you go to the accountant. Okay. When you come to accountant, you find the article make journal entries. Okay, so you click on it. To open. Okay, so always try to maximize so that you see everything. Okay, so this is where we shall be at. Then we capture our information. So we had delivery trucks. So of course you don't have that information. You're starting new QuickBooks, new everything. So you won't be having that. So you always be forced to add. So you come and add new. Okay, maybe I forgot to talk about the date. I'll just talk about shortly. So you got the fixed asset because delivery vehicle is under machines and equipment or vehicles. So it falls there. So when you continue, account name will come. So we're saying delivery trucks. Guys, please mute it. Delivery trucks. Okay, you don't have to say anything. Just say close. Okay, save and close. So we know that for assets we debit them and then credit opening balance equity. So how much was it? I won't be sharing the question like often because I expect to be having it. Otherwise, the cost is 70 million. So we put 70 million. Okay. Then click on the next line. The credit will always come automatically. If it doesn't come automatically, try to clear and retry. It should come automatic. Then we credit opening balance equity. Okay, this is usually in there. There, good to go. And then the date. The date I've already told you it's 1st January. 1st January 2018. Okay, Okay, then you save and close or new. You shall do new because you have other items to put. So save and new. Okay, and then we have accumulated depreciation of this very track. Maybe you should first do the cost for the other item also, which is building. Building at cost is 100 million. So you come here and you say building. So of course I think I would have the building here unless otherwise, but supposed to add it. So you click. It is under fixed assets because it's a building. Here it is. You'll see it there. Okay. Then you continue. Okay. Then you put in building. And then you save and close. Okay. So it is 100 million. So we're debiting building with 100 million. And then just click on the next row. The credit will come automatically. Then still opening balance equity is what we call it. Okay, the date is 1st January 2018. Then you save, and this time, okay, new. Okay. Then you can now look at accumulated depreciation opening balance. I hope we're okay with fixed assets. That's how we capture the opening balances. Debit the asset, credit opening balance equity. What does that sound mean after entering? Nothing. Don't have to worry about it. It's 31st now. I know it's 31st here, but like I've already explained, maybe you came in late. I think you came in late. Guys, these are not, okay, let me just share with you a question again. These are not end of year balances, okay, like you guys are trying to imply. These are not end of year balances, okay. What happened is they brought in a new system, okay. The information we have 31st December 2017 information, your trial balance regarding all your assets liabilities is regarding 31st December 2017. And I'm saying this sets our base for the opening balances. Okay. So opening balances do not start on 31st December 2017, but rather 1st January 2018. What you're capturing are opening balances. They start the year. Okay. These are not end of year adjustments like you guys want to put it. Okay. It's a new system. We're capturing information from the past that we had so that we commence the system with this information. So you don't put 31st December, but you put 1st January 2018. I hope that makes sense. Okay. The end of year adjustments that you want so badly, you shall see them. That's where depreciation falls. Or is it? Yeah. They said on 31st December 2018, salaries and wages were this accrued. Then they said the company depreciates its building at 5% per annum using straight line method, and delivery trucks are depreciated at 10% per annum using reducing balance method. Okay. So guys, that's what I'm trying to say. So let's continue. We are going to capture what accumulated depreciation. So for the asset you cover, so let's look at accumulated depreciation. So we're given accumulated depreciation for the truck or the delivery trucks at 14 million. But the question requires Okay. All right. The required here is saying that part C, customize QuickBooks chart of accounts to that of Jojo Distributors Limited. Take on the opening balances of the assets, liabilities, and equity using general journal entries. Generate a report in PDF format showing a summary of adjusting entries as of 31st December 2017. Okay, so based on this question, I think she'll have to use 31st December 2017. Okay, thanks, Davison. Guys, are we okay? The required wants you to generate those journals, the report for it as at 31st December 2017. So if you put 1st January 2018, you won't be able to generate this report. It won't show. Okay, so I think I have errors there, so I have to go and edit. Okay, now in editing, let me take you back to the question. I thought I was sharing it. Okay, I have to go back and edit the dates. So we know that for editing, you just the arrows just work for you. Okay, so here I'd put 1st January, but I don't think I was right because the report won't show if you have these. So you go 31st December 2017, and then you save and continue. Yes, do you want to save? Yes. Okay, and then there was this other also for the building, supposed to show 31st December 2017. Then you save and renew. All right. So do we still credit? Yes, you still credit. The entries remain the same. You debit the asset, okay? Credit opening equity. It's only the date that is changing. So we go to estimated depreciation, which is 31st December. Guys, please mute. Betty, Christine. Okay, so accumulated depreciation, we know that we are supposed to debit opening balance equity because accumulated depreciation has a credit balance. So for it to be included, must be credited. So in that regard, the first debit, opening balance equity, debits come first. So always have debits coming first. Okay, and it is 14,000 for 14 million, sorry. As far as the revenue is concerned. Okay, so as you can see, once you click on it, the thing does not come. And usually this happens because if you think with these rows before, it won't be automatic. So what you do is you clear this information so that you have automatic stuff. So when you clear, the date is important to read agreed, it's 31st December 2017. Okay. And they're saying that we are going to debit opening balance equity. Okay, with the amount which is 14 million. Okay, so when you click on it, it comes automatically. Then you add. Okay, in adding, we're saying accumulated depreciation is under fixed accounts or fixed assets. The only difference is that for it has a credit balance. So you'll say accumulated depreciation delivery trucks. Okay, you don't have to write this in full because usually this space is small. So let's try to abbreviate. Okay, and then you save and close. Okay. So we have captured opening balance of accumulated depreciation of the delivery van. Save and new because you also have the one of building. Okay, for the building, I'll check the amount with you guys. Okay. For the building, here, accumulated depreciation for the building is 10 million. Okay, yeah, 10 million. So we go and input that. So we know you're supposed to debit opening balance equity. Okay, it's 10M. And then you're supposed to credit accumulated depreciation of building, where you go to fixed assets and then you write accumulated depreciation. Building, and then you save and close. Okay, so once you have that, then you save. Save and close this time. I'll save a new, doesn't matter. So we are done with our assets. Opening balance and closing balance. Still confused on the date. Okay, the date is okay. Let me share with you. I also thought it was 1st January 2018. However, they asked for something in the required. Here required, they said that customize QuickBooks charts of accounts, that of Jojo Distributors Limited, and then take on the opening balances of the assets. Like you saw, we're given 31st December 2017. Those are opening balances for the year. Okay, you know that 31st December 2017 and 1st January 2018, they're not very far from each other. Okay, like I said, they're a few seconds, okay, apart. However, the required bit makes it easier for you now. It said that generate a report in PDF format showing a summary of adjusting journal entries as at 31st December 2017. So they are specific. We should use this date of 31st December 2017. And that is why we're using it rather than 1st January 2018. Okay, I hope I've answered that question regarding the date. So let's go to now the depreciation now itself. Oshino, you guys kindly behave now. Kindly behave, clever. You guys, please. Bonix, please mute. Bonix, kindly mute. So, guys, now back to depreciation, where there's really what my interest. They say that not 31st December 2018. Now this is their end, yeah. Okay. Salaries and wages of this accrued. I'm not going into that. So not 9 is where my interest is. They say that the company depreciates its buildings at 5% per annum using straight line method. Okay, maybe before that we can try to confirm if there were any transactions regarding buildings and deliveries. Did they buy any? Did they sell off any? Because that will affect our transactions. So if I peruse through, I'm not seeing any purchase or any constructions. Fund, company purchase this Pepsi. Okay, so there's no any other capital expenditure. Okay, so they're saying buildings we use 5% on straight line. Now for straight line, we know that you charge the rate on what? We charge the rate on cost. So let's deal with that first, building. Okay, now a friend of mine visited Opiso and Mr. Opiso, sorry about that. And they talked about it, and we're saying depreciation going forward, you're going to compute them manually. Okay, because straight line doesn't change, it is on cost. So how you get your costs, you know better. Okay. Using the register like we're using before, it actually gives us cost, which is good. Okay, but also with your eyes or with your observation, you can see that the cost is given. Okay, so we're given the cost as okay, just because we're going to compute using this calculator here. I hope you have seen that part. Okay, this is your calculator. Okay, so we have seen that the cost is for the motor vehicle. I'm dealing with building first. So we're seeing the cost of building. Remember what we put in. Okay, we put in the cost of building as 100 million. So they want 5% of 100 million. 5%. So back to our calculator. It's here under edit. Use calculator. So you say 100 million. Okay, and then multiply it by 5%. The answer you get is 5 million. Now that's your depreciation figure. And we know that whenever you have a depreciation figure, you just debit depreciation and then credit accumulated depreciation. So coming to workings in the journals, we're saying it's 5 million. Okay. And then we are depreciating. So we add new. It is an expense. Depreciation is an expense. So you debit depreciation. Okay, but specifically, it's building. Then you save. Okay. Then we credit accumulated depreciation. This one we have it already. You just look for it. Accumulated depreciation building. Here it is. So you just click on it. And then the date is important. Okay. The date for depreciation, it is at the end of the year. And this time it's not 31st December 2017, but rather 1st December 2018. Okay. And then you save and renew. Okay. All right. You can answer your questions. I think you have so many questions here. Pardon, why we don't use the register? Okay. Use the calculator. Okay. There is a use calculator. Then what? Pardon, the calculator 5M. So when do you generate the profit or loss? What date shall we range from? 1st December. For the P&L to be from 1st January 2018 to 31st December 2018. You're interested in the transactions that happened within the year. So these balances, as dated 31st December 2017, they occurred in the previous year. So you have nothing to worry about, Esther. I thought fixed assets you capture through just accounts and no. Whereas charts of accounts can work for fixed assets and even liabilities, you are advised to use journals because one of the roles of journal entries or journals is to capture opening balances. So they want to see you using journals to capture those balances. Agnes. Okay, kindly learn this because Mr. Piso emphasized this when I reached out to him. He said that opening balances, all of them, you must use journals. Okay. Agnes, I've answered you, meaning that we don't use any issue of 2018 figures. We not understood that one, sweep up, meaning we don't use what? We don't issue any of. I was understood that, but the year we're looking at is actually from 1st January 2018 to 31st December 2018. So transactions in between shall be considered. But these opening balances of 31st December 2017 are still important because they're going to lead us into our balance sheet of 31st December 2018. Okay, but the physical date will remain first. Yes, the physical date will remain first. Yes, 1st January 2018. Esther. Okay, Mr. Lecturer, and the question on issue of date told me that the question is not proper because the closing balance, you see, because the closing balance of the year began the opening balance of the new year. So I just wanted to notice that 1st December 2018. That's to answer your question. You see, opening balances only affect the closing balances, the balance sheet to be specific. And the balance sheet is as at 31st December 2018. It doesn't mind whether you had your opening balances in 2018 or you had them in 2016, wherever you had them, opening balances do not affect the balance sheet negatively. Whichever date you include them, they don't. Okay, the only issue of the opening balances being in a previous period can only affect maybe the P&L, profit or loss, which starts from 1st January to 31st December in between. But still, as you appreciate that balances refer to assets, liabilities, and equity. They have nothing to do with expenses and incomes. So still they won't affect the P&L statement. Okay, so for the dates, I can assure you, I think this question was fine. Okay, because they guided you on the journals that they want. If you're going to issue a P&L, you must start from 1st January to 31st December because transactions occurred in between. These are opening balances, they're not transactions. So I really see no issue, Musa, for that regard. I hope I've answered most of your questions. Agnes, I hope you have together on that. Esther, yes, the period will always be 1st January, 31st December, 2018. Okay, the amount is 5M, true. Okay, go to edit. Yes, for the calculator, you go to edit. I think that's where the questions are. And why are we not using a register and stuff like that? Remind me, guys, I'm going to talk about creditors and vendors. Okay, remind me what depreciation is in terms of balance sheet. Okay, don't we put percentage in the figure? And under what circumstances do we debit? We debit accumulated depreciation when you're disposing of the asset. If you're disposing of an asset that already had accumulated depreciation before, we debit it. Then open. Okay. How do we enter the retained earnings? Guys, I didn't come to talk about this. Kindly stick to depreciation and assets for now. Okay. So to answer Susan's question, accumulated depreciation refers to depreciation that has been accumulated or has been added over the years. Okay, that's what we call accumulated depreciation. Usually, if you're using straight-line balance, the depreciation that we accumulate over the useful life of the asset will always be equal to the cost of the asset. Okay, accumulated depreciation will usually reduce the cost of the asset to zero along its useful life. So I don't know if I've added anything on that, Susan, but from our accounting one, we debit depreciation as an expense and then credit accumulated depreciation as it's like a liability, but it's not a liability because it doesn't appear on the face of the balance sheet as a liability, but rather it goes as a reducing figure under the asset. So it has a credit balance. It's more of a provision if you ask me, because depreciation is a non-cash flow. Okay, so whenever we record that expense, we normally have to, for every entry, for every debit, you must have a credit. So whenever we debit depreciation, we credit accumulated depreciation. And what accumulated depreciation does in the balance sheet, it reduces the cost of the asset. Okay, so I beg to stop there on that. Now to answer the other part. Now, guys, for the register, it is still fine. If you go to register, use register. You can either go to banking or you come to edit. You will see the register. So you come here and look for the building. Okay, it's actually buildings, if I remember correctly. It's building there. Okay, and you say, okay. The truth is that the register will give you the cost. Okay, this will be the cost, and you'll be fine. Okay, so you say 100 million times 5%, you get the 5M. So it is still fine to use the register to get the cost. If you go to the charts of accounts, it will still give you the cost. I try to observe it, and that's the fact. You can go there and we see. Go charts of accounts, which is under it's under accountant. Okay, now unfortunately this link is going to close, so if you can join in the next link, then you start from there. Okay, so otherwise, when you go to charts of accounts and you look at building, which is a fixed asset here, okay, you'll see that it has 100 million. Okay, still this is the cost. It will still give you only the cost, not net book value. So it's why I charge the 5%. Okay, then for the calculator, I said you come to edit, then you will see it here. Under edit, you will see use calculator. When you click on it,